If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all.
Look, guys, us stock market investors have had it pretty good for the last decade or so. Yeah, there have been up and downs, including COVID crash, but here we are, all-time highs yet again, and it feels like it's probably not going to stop. It's all too easy to get comfortable, maybe even feeling a little spoiled. And you could get blindsided when a correction or even a crash hits. A lot of people think that the inevitable crash is coming very soon based on the fact that Warren Buffett's holding $344 billion in cash. They believe his behavior is signaling a crash. Why? Well, back in 2000 and 2008, he held a lot of cash. But even so, this is a record for him right now. Now, to put that in perspective, his $344 billion is more than double what they had just a year ago when it was $167.6 billion. But here's the kicker. It's not just that he's holding cash. Buffett has been selling those stocks for 11 straight quarters. He has been dumping shares of companies he used to love, that he used to revere in a public fashion. Apple, Bank of America. Now, when the Oracle of Omaha starts doing this, people pay attention. And here's where it gets really interesting. This isn't the first time Buffett has done this. Let me walk you through this. Back in 1999, right before the dot-com bubble exploded, Berkshire Hathaway was sitting on over $15 billion in cash. Doesn't sound like a lot compared to today's levels, but that was 26 years ago. The company wasn't a $1 trillion company back then. This was a huge piece of their net worth. Everyone thought Buffett was crazy for not buying tech stocks. They said he was missing out. The dinosaur was missing out. Then the bubble burst. Fast forward 9 years later, 2008. Before the financial crisis really hit hard, Buffett had about $44 billion in cash just sitting there, 3 times more than he had in 1999. And when the market crashed, he swooped in and made some incredible deals like his investment in Goldman Sachs. Now, guys, what's funny is I just saw something on Instagram the other day where it said Buffett almost went bankrupt in 2008. And I was like, no, he didn't. Everybody's like, yeah, he owned banks and they went under. None of the banks that he owned went under. In fact, he was the savior of banks, like that investment in Goldman Sachs. He was the one that gave confidence in the market. But back to his cash, do you see a pattern? And by the way, back in the late 60s, to go to even more extreme, he thought things were so overvalued back then that he ended his partnership, gave them all their money back and said, I got nothing to buy. Well, what's scary is, based on every reliable metric of stock market valuation, we are far more overpriced today than we were back in the late 60s when he shut down his very partnership. Buffett likes to build up cash. Everyone thinks that he might be too cautious. Why? Well, because stocks keep going up. But eventually, the bubble bursts, and suddenly he looks like a genius after the fact. Now, to be clear about this, Buffett isn't sitting on over $344 billion because he's trying to time the market or predict some sort of crash. That is not how he operates. He's holding this cash because he thinks everything is just too expensive right now. He has said this many times before. In his latest annual letter, he said that there's nothing compelling to buy. That's Buffett speak for everything costs way too much. And you know what? He's getting paid to wait. He's out there collecting 4.25 to 4.5% on short-term treasuries. On $344 billion, that's almost $20 billion a year in interest income just for being patient. So the question is, why does Buffett think everything's too expensive? Well, his favorite metric, it's actually been called the Buffett indicator. It's the stock market to GDP ratio. Think of this as the price of the entire stock market compared to the entire economy, and it makes sense. The bigger the economy gets, the bigger the stocks within that economy should be worth. Historically, this ratio is about 90%. So the GDP of the US economy, the stock market should be about 90%. Right now, we're over 200%. We're at like 210% of the value. That means every investor is paying over double what they should based on what this indicator has historically done. Guys, this is substantially even higher than during the dot-com bubble. So what does this mean for you as an investor, whether you're new or more advanced? Well, when you start from high valuations, future returns tend to be pretty disappointing. We're not saying the market's going to definitely crash, but earning more than 5% annually over the next decade is going to be tough from these levels based on history. Now, here's something most people don't realize about Buffett's situation. Having over $344 billion sounds awesome, but it's actually a huge problem when you're trying to invest it. See, if you and I find a great deal on a $1 billion, $2 billion, $5 billion company and it doubles in value, we are doing cartwheels down the street. But for Berkshire Hathaway, with a $1 trillion market cap and $344 billion, if they bought a $5 billion company and it doubled, they wouldn't even notice it. Great, a $5 billion gain on a $1 trillion company is 0.5%. Buffett needs to be able to invest tens of billions at a time to move the needle, to make a meaningful impact on Berkshire's performance. And he has said this many, many times. He has said, as we get bigger and bigger, it'll be harder and harder to outperform. And if you look at history, going back to the 1950s when he started, apart from 50s and 60s, every decade as he's existed, he has outperformed the market still, but by smaller and smaller margins each time. So for him to find these opportunities, that's very, very, very rare, especially when everything's overpriced. Buffett has said if he only had $1 million to invest, he said, and I quote, "I guarantee I'd make 50% returns per year." The reason being, there are tons of undervalued small companies out there, but Berkshire itself can't buy small companies in order to move the needle. It needs the elephants, and the elephants are expensive these days. Buffett isn't predicting doom and gloom. He's just being patient and waiting for better opportunities. Now, here's the key insight that separates the super successful investors from the rest of us. Price is not the same as value. Price is what you pay, value is what you get. In fact, I need to tell you something that might save you thousands and thousands of dollars. A great story doesn't make a great investment. This is probably the biggest mistake I see beginners making. This is why it's the fifth but most important tenet of our principle-driven investing. A great story can become a bad investment if you pay the wrong price. Now, this is very, very important what I'm about to say. If you're new to investing, if you're new to this channel, I want you to rewind and listen to that again. A great story can become a bad investment if you pay the wrong price. If you hear that and you think, oh my God, never heard that before. This makes sense. Listen. If you hear that and think, this guy's an idiot, go away. Nothing I'm going to do is going to save you. But if you're also in the middle where you go, okay, I could see how that makes sense, there's hope for you. We're here for people trying to get better at investing, trying to up their investing game. And this is probably the most important tenet I talk about. If you believe that a great story has no price, and you might sit there and say, well, of course it has a price. But if you find yourself always justifying a higher price, that means no price is too high. But if you believe that this wonderful $1,000 iPhone, even though it's the best phone in the world, can be overpaid for, if you think a Ferrari, the best car in the world, you can pay too much for, then there's hope for you in investing. You're going to do a great job. Now, the biggest mistake I see beginners make is they hear an amazing story about a company. And guess what? When I say beginners, I include myself. I was there. I was the guy who heard a story, who heard a tip and said, that's an amazing story. There's no way they're going to miss. And guess what? They missed. Guys, in fact, I don't remember ever chasing a wonderful, amazing story without looking at value and getting it right. As crazy as that sounds, it is true. But what most people think is, this story is incredible. I need to buy the stock right now. Guys, AI companies are going to go under. Electric vehicle companies went under. Cannabis companies went under. Internet companies went under. Computer companies, real estate, all these great stories. Look at airlines and car manufacturers. From 1900 to now, more money has been lost in airlines than has been invested in airlines. It's a net loser investment. Yet how much bigger is the airline industry today than it was 100 years ago? It's a phenomenal story. Cars, same thing. How many car companies made it? Thousands and thousands and thousands of car companies failed. Basically, a few in this country made it. And guess what? Cars were way bigger today than they were 100 years ago. But here's what nobody else on YouTube is going to tell you. When someone tells you about a company that's going to revolutionize transportation or cure diseases or send people to Mars, your brain lights up. You start imagining all the money you could make if you could just get in early. But the problem is, and this is huge, Wall Street knows that you love stories, and their job is to sell. Their job isn't to invest. They know that exciting narratives sell stocks. So they're more than happy to package up all these amazing stories and sell them to you, often at a ridiculously high price. Guys, once I learned how Wall Street takes a company public, it made me realize this is all a bunch of bullshit. Their job before a company goes public is to go on a road tour. And they basically just market the crap out of the company and how amazing it is. It's all about the story. Think about it like this. Imagine someone selling you a really awesome sports car. It's got all the latest technologies. It looks amazing. Everyone's talking about it. But they want $200,000 for a car that might be worth $50,000. Yeah, it's a great car with a great story, but you're getting ripped off, right? That's exactly what happens with story stocks. Guys, reminder, a great story can become a bad investment if you pay the wrong price. No matter how incredible a company sounds, no matter how incredible their story sounds, whether they're working in artificial intelligence, space travel, plant-based meat, or whatever story comes up in the future, if the stock price assumes everything will go perfectly for a long time, you are not investing anymore. You're gambling. You're speculating. Now, okay, let me give you a real-world example of how this plays out. Let's say there's a company that makes electric vehicles. Great story, right? Well, guys, the story was a lot more attractive 10 years ago. But electric cars were considered the future. Climate change was a real problem. This company was going to change the world. But here's where it gets tricky. If everyone loves the story so much that they're willing to pay 80 times what the company actually earns in profit, you've got a problem. The problem isn't with the one company. The problem is with taking every company that come along that looks the same and applying the same metrics. They're not all going to make it. Remember, you're not buying what a company is worth today. You're buying it based on what the future hopes and actual performance ends up being. But the question is, how many companies can share in that? And if one is the leader, theoretically, no price is too high. If that's the one that's going to win, let's go to extreme, $100 trillion, 3 times the US economy. Well, come on, Paul, that's too high. That's my point. Zero's too low, 100 trillion is too high. Somewhere in the middle, it makes sense. But the closer and closer we get to value, the grayer it becomes, especially when we don't know the size, because the story is so great. When you pay a huge premium, you're essentially saying, I believe this company, sector, whatever, will never make a mistake. They'll never face competition. They'll never hit any road bumps and will grow perfectly for the next decade. That could happen, but that's not how business works. Companies face challenges. Eventually, the CEO all of a sudden gets his political leanings coming out. He goes and buys Twitter, and before you know it, people went from this guy is the best thing that ever happened in this world to this guy is evil. Sound familiar? You know exactly what I'm talking about. I'm talking about Tesla. And you might sit there and say, well, Tesla is back up to 400. Guys, it was at 400 4 years ago, and the company's a lot bigger today than it was 4 years ago. And guess what? The company's struggling. They sold less cars this year and have less revenue this year than they did last year. And when reality doesn't match the perfect story, then everyone starts selling and the price starts to come down and crash. So what does this mean for you as someone who's just getting started with investing? First, don't let excitement override common sense. You have what it takes. You have the knowledge. You've made it this far in this video. You have the knowledge to be successful. Yes, it is so much fun to imagine getting in early on the next Apple or Amazon. But for every Apple out there, we don't hear about the thousands and thousands of companies that had the same exact exciting story that went nowhere. And you might sit there and say, well, Paul, there weren't other Apples. Exactly. There were ones that tried to be Apple. There were ones that had other products they thought would be like Apple, and they didn't hit it. And if you're banking on finding the one perfect company, it's not going to work. Second, try to separate the story from the investment. Ask yourself, if this company's story comes true, am I paying a reasonable price for it? What does that mean? Well, you have to sit there and say, if the story comes true, how much money will they make? What would that be worth for them in 10, 15, 20 years? And then what do I have to pay today to make that make sense financially? Remember, we talk about all these. If you go back 4 years ago and look at the assumptions made on Tesla for revenue and sales, it wasn't what they're doing today. It was far greater. The two biggest bulls of Tesla thought by now Tesla would be selling a minimum of 5 or 6 million cars a year. They're going to struggle to sell 1.7 million cars. If the stock price assumes perfection, you're probably paying too much. Third, missing out on one overpriced stock is not the end of the world. There'll be other opportunities, but losing a big chunk of your money on an overpriced story stock, that can hurt your long-term financial goals. And guys, I want you to keep in mind, I'm not saying you should never invest in innovative companies or ignore great stories. A story is so important, but the story by itself is a fairy tale. The numbers by themselves is an Excel sheet. And some of these companies really will change the world. And some of them will really make investors a lot of money. But guess what? The same people who chased ARK Investment overall have lost money, even though ARK is up from its original price. Why? Because they got in when the price was too high. But someone who's just starting out, your number one job isn't to hit home runs. It's to not strike out. Remember, if you go and you have $10,000 and it falls to $1,000, that's a 90% loss. You have to gain 900% to get back up to 10,000. How long does it take to make 900%? And yes, folks, it is 900%. It's not 1,000%. It's 900%. How long do you have to take? Decades? That's the problem. Now, if you're making small bets on all of them, and a lot of people do this, they make small bets on a lot of ideas and hope that a few of them, that's called venture capital. Venture capital goes out there and they invest in 10 companies. They know 7 are going to be colossal failures. 2, they'll probably get their money back on, but 1 will drive all the returns. Guess what? It's very stressful, and they have hands-on access to the company where they can change things as they go along. You can't do that with stocks. Your job is to protect your money and grow it steadily over time. Is it sexy? I have a question for you. What's sexier, being rich as F when you're 65 or trying to figure out how you're going to survive retirement? The most successful investors that I know and I've ever heard of, they don't chase exciting stories. In fact, if they see an exciting story, they stay away from it. They stay disciplined. They calculate what things are actually worth, and they never, ever let a good story convince them to pay a bad price. Now, guys, I talked about the principle-driven investing. There are 5 tenets to it. I talked about the 5th one. There are 4 others. I want you to do me a favor. If you're serious about investing, if this makes a lot of sense, click the link below. Absolutely free PDF will explain all 5 tenets to you. What they mean, how they apply. These are great tenets to have no matter what you're investing in. And even if you're not investing in stocks, it's a great idea to have with you because eventually we will have a bear market. And when that bear market hits, you still need to have these tenets inside you to understand that things will get better. Just like now, you can't assume things will never be bad. Good times don't last forever and bad times don't last forever. Back to the quote from Buffett at the beginning of this video. If you're going to do dumb things because your stock goes down, you shouldn't own any stock at all. Some people are not actually emotionally or psychologically fit to own stocks. That's really important to understand. I was just in one of our classes today, our foundations course for our class. And people were talking, and it came up about buying stocks. And I said, I don't need to buy stocks individually, but I do it for a couple of reasons. One, I do have low-cost ETFs that I buy every month, even at these high valuations. But I only buy stocks that I understand, that I want to own, and at good prices, because I was emotionally fit to sit there and see a stock go down in half and be okay. Prime example is Alibaba. I started buying Alibaba sub 150. And when it got to 60 or 70, guess what people on the internet were saying? You're an idiot. You're dumb. It's at 166 now. Okay. I'm just as excited about that as I was when it was at 60 or 70. It's like, okay, fine. It is what it is. I am meant for that. But I wasn't back in the day. I was exactly like everybody else. I was an emotional train wreck when that kind of stuff happened. So what is Warren Buffett talking about? Stocks go up and down literally all the time. Sometimes for absolutely no reason at all. The dumb thing that Buffett's referring to is panicking and selling at a loss when nothing has actually changed about the business itself. Buffett's basically saying, look, if you can't handle the roller coaster, do not get on the ride. Investing is more about psychology than it is about math. You could have all the financial knowledge in the world. You could have a PhD in economics, a PhD in math, and a PhD in finance. But if you panic every time the market has a bad day, you are going to lose money. And the brutal truth is that successful investing requires you to do the opposite of what feels natural. When stocks are falling and everyone's panicking, that's often when you should be buying more. When stocks are soaring and everyone's getting greedy, that's when you need to be a little bit more cautious. That's what we talk about on this channel. That's why if that makes sense to you, stick around. Watch some more videos. So guys, let's bring this together on these 2 concepts. Warren Buffett sitting over $344 billion in cash for one simple reason. The market's overpriced. Everything has been bid up to prices that assume perfection. And Buffett doesn't play that game. Here's where his temperament really shows. If the market crashes tomorrow, if stocks drop 30, 40, 50%, what do you think Warren Buffett would do? Is he going to panic and sell his Apple or Coca-Cola positions in full just because their stock prices fall? Of course not. In fact, he says, when hamburgers go on sale in the Buffett household, we tap dance down the street and buy more hamburgers. Remember that Buffett's timeline is measured in decades, not months, which is especially important for a guy who's 95 years old. He is positioning Berkshire for the long term because he understands the difference between price and value. He wants to buy when value is above price. And a temporary drop in stock price doesn't change the fundamentals of the business and therefore does not change the fundamental value of the business. If anything, he is more excited and he's going to step up and make a purchase. This is exactly the mindset I want you to develop. I'm not telling you to become like Buffett, but if you can get a little bit closer to that mentality, it'll really, really increase your returns in the long run, but most importantly, increase your calm and peace of mind. Now, here's something crucial. Don't just blindly copy Buffett. Don't copy anyone in this world. You're not Warren Buffett. I'm not Warren Buffett. But what you should copy is his process. Learn to evaluate price versus value and stay calm during volatility. Think for yourself. Understanding that price and value are different is a crucial first step, but it's just the beginning. The real skill is actually determining what something is worth. Everybody watching this video has bragged to somebody else about how they bought something for less than it's worth. No different for stocks. But in the investing world, we brag when we overpay for stuff. That's the weird part. So how do you analyze a stock and figure out if it's fairly priced or overpriced? How do you separate the hype from reality? That's exactly what we cover in our full course linked on the next screen. I'm going to show you step by step for free how to determine intrinsic value and make decisions based on facts, not emotion, because successful investing isn't about predicting where the market will go in the short run. It's about understanding what businesses are worth and having the patience to buy them at reasonable prices. Thank you for your time.